What if I told you there's only one investment strategy that survived every single market crash in the last 100 years? Not Bitcoin, not gold, not real estate, something so simple yet so powerful, it turned ordinary people into millionaires while others lost everything. Picture this, it's 1929. During the Great Depression, the US stock market collapsed nearly 80%. People who bet everything on stocks fully wiped out. But the few, they actually came out richer. Fast forward to 2008, banks are collapsing, families are losing homes, yet the same type of investors are quietly buying up assets while everyone else panics. 2020, COVID hits, market crashes more than 40% in weeks, and guess what? They're doing it again. Here's the kicker. This isn't some Wall Street secret or insider trading. It's so boring, most people ignore it. So simple, a 15-year-old could do it. Yet, it's creating more millionaires than almost anything else in history. Think about every major crash. The Great Depression, oil shock of 1970s, the dot-com bubble, the 2008 meltdown, the COVID crash, millions lost everything. But a small group not only survived, they thrived. The shocking part, they weren't necessarily smarter, they just followed one boring rule you have probably ignored. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, on one of India's top wealth management firms before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. Here's a basic strategy for life. To beat your enemy, you need to understand your enemy very well. Market crashes aren't random, they are like chain reaction. They need 3 things: overvaluation, too much optimism in the system, a trigger event, and a panic selling to spread. Let's look at examples. In 1929, during Great Depression, people were buying stocks with borrowed money. When prices fell, forced selling created a death spiral. In 1970s, oil prices quadrupled overnight, stagflation crushed economies. In 2008, during subprime crisis, reckless lending plus bad loans became a global house of cards. And during 2020, during COVID, lockdown shut the world economy overnight, and the psychology makes it worse. Panic selling. Our brain screams, sell now at the worst possible moment. Herd mentality, we copy the crowd even if they are stampeding. Liquidity crunches, leveraged investors forced to sell accelerate the crash. It's not just numbers falling, it's human fear amplified. By the way, if you're finding this useful, just hit the like button and subscribe. It's a small thing, but it tells me you want more of this content, and it really helps me stay motivated to make more such videos for you. So, how do most investors react? They try things that almost always fail. Timing the market. Trying to predict the tops and the bottoms is impossible. Panic selling. Locking in losses permanently. Hiding in safe assets like FDs or only gold. Safe today, but in 20 years, inflation eats them alive. Here's the pattern. Every failed strategy comes from emotion and not discipline. So what actually works? The strategy that survived every single crash is built on 3 important principles. Number 1, diversification. Don't put all your eggs in one basket. Let's take an example. In 2008, stock crashed 38%, but a diversified portfolio was down only 22%, nearly half the damage, and it recovered faster. In 2020, diversified investors were back in profit within months, pure stock investors still waiting. 2, rebalancing. Here's the difference between panic and discipline. In 2008, stock fell hard while bonds held steady. Most people sold more stocks, smart investors sold a little of their safe bonds and bought stocks cheap. When the rebound came, those buys doubled or tripled in value. That's rebalancing. Buy low, sell high without guessing. 3, consistent investing, also called as rupee cost averaging, or in simple terms, SIP or systematic investment plan. Instead of lump sum, invest a fixed amount every single month. During crash, you buy more units. During market highs, you buy fewer. Over time, your average cost drops. Let's look at a real example. In 2020, investors who kept their SIPs running doubled their portfolios in just 18 months. Those who stopped missed the recovery. So do you notice the theme? Diversification cushions, rebalancing positions you, and SIPs build wealth quietly in the background. Quick question for you. Do you keep investing during crashes or do you pause? Do drop your answer in the comments. I would love to see how you handle these situations. Now, you will be saying, I want proof that this strategy works. Look at Warren Buffett. Since 1965, Berkshire Hathaway has averaged 19.8% returns annually, almost double that of S&P 500. What's his mantra? Be fearful when others are greedy and be greedy when others are fearful. By 2024, he sat on 340 billion cash waiting to buy when the next crash came. Discipline, not prediction, made him one of the richest investors alive. So, how to build your own crash-proof plan? 50 to 60% equities through index or diversified mutual funds, even 70% if you are young and want to be a bit more aggressive. 25 to 35% in debt instruments or bonds. It can be a combination of government and corporate debt papers. 10 to 15% in gold, commodities, or even Bitcoin. 5 to 10% in cash buffer, not to left idle in liquid funds but ready for purchasing those dips. If you think this is too much hassle, there are multi-asset allocation funds that do the heavy lifting for you. But trust me, if you spend some time, you can actually make this very effective because honestly, it's not that much effort involved here. But here's the catch. The math works only if you stay disciplined. If you panic, the system fails. See, what's important to understand that all strategies have its negative. Even diversification isn't perfect. 2022 showed us that. That's why modern portfolios add commodities, inflation-protected bonds, and global exposure. For Indians, international funds also hedge against weakening rupee. The goal isn't about creating that perfect portfolio, it's a resilient one, flexible like a bamboo in a storm. So here's the truth. Diversify, rebalance, keep investing consistently, and above all, stay calm when others panic. Because crashes are temporary, but growth, that's always permanent. Share this with someone who panics at every market dip. Comment your thoughts below and I'll always personally respond. That's it from me. I'm Nikhil Verghese. Share this video and subscribe to learn how to make your finances less tricky with Finicky.